Hey everyone, and welcome to The Explainer. If you really want to understand what's happening in modern fintech right now, you kind of have to think of it like a group chat where three friends are having completely different weeks, right? One friend is just popping champagne over this massive work win. Another is nursing the sting of a pretty harsh rejection text. And the last one, well, they just got their hands on a brand new, shiny toy. So today, we're looking at three distinct vectors of the digital money landscape to see exactly how your money is moving behind the scenes, and honestly, what it all means for the future of your wallet.
Okay, let's dive into our agenda for today. First up, the win. Adyen and Toast take America. Then, the loss. U.S. regulators block Bunq. And finally, the play. Venmo joins Google Play.
Section 1, the win. Adyen and Toast take America. So Toast, which you probably know as the absolute giant in restaurant point-of-sale systems, and Adyen, a massive global payments powerhouse, just announced they're officially expanding their partnership. They're making it U.S. official after quietly, working together over in places like Ireland, the UK, Canada, and Australia. But let's break down exactly why this matters for us. What you and I see as everyday consumers is just the front of house, right? The sleek Toast POS screens, the online ordering, the ticking menus, the loyalty programs at your favorite local taco spot. But beneath all of that is the back of house, which is now being powered by Adyen. Adyen provides this totally hidden infrastructure layer. They're the global payment rails that actually make the money move. By bringing Adyen in, Toast is drastically reducing their integration headaches and stability issues. Because, let's be real, the only thing literally worse for a restaurant than running out of food is having a Friday night POS system meltdown going viral on TikTok. Adyen is basically the invisible shield preventing that from happening.
I absolutely love this analogy right here. This is the payments equivalent of your favorite local band signing with a bigger label. I mean, it perfectly captures the deal. Toast is still giving restaurants the exact same reliable product they already love, just with way more reach and stability under the hood. As brands expand internationally, having just one rock-solid rail underneath all of their systems, that's a real game changer. It just brilliantly shows how infrastructure is quietly eating the world, literally one credit card swipe at a time.
But you might be wondering, what happens when all that boundless tech ambition slams face first into a cold, hard regulatory wall? Section 2, the loss. U.S. regulators block Bunq.
Okay, so Bunq. They're Europe's second-largest neobank based over in Amsterdam, and they just got completely, flat-out denied a U.S. national bank charter by the OCC, the Office of the Comptroller of the Currency. This decision dropped on August 4th, and it actually marks their second failed swing at entering the U.S. market after they had to pull an application earlier in 2024. Now, what's really wild about this is the number behind their latest attempt, $58.3 million. That's the amount Bunq projected for their initial U.S. capitalization. They actually bumped it up from $50 million during the application process. Now, you'd probably think waving nearly $60 million around would open at least a few doors, right? But nope, even with that massive figure, they still got a firm rejection.
And here is exactly what the OCC had to say. The denial letter cited significant supervisory and compliance concerns. That quote makes one thing abundantly clear. U.S. regulators are absolutely not just rubber stamping these applications, no matter how popular your app might be over in Europe. Let's dig into the micro-narrative of exactly why they got rejected, because the OCC had some very specific gripes. First off, despite that $58.3 million war chest, Bunq had a really unclear articulation of how those U.S. capitalization plans would actually work in practice. Basically saying, hey, we'll figure it out later, absolutely does not clear the OCC's bar. Second, regulators flagged a total lack of stateside experience when it came to running unsecured credit cards. And finally, this isn't just happening in a vacuum. This really echoes a broader OCC crackdown. Actually, even fintech giant Wise recently had their U.S. trust charter application denied over compliance and anti-money laundering concerns. Think of the current regulatory environment like the NFL draft of banking. Foreign neobanks are these incredibly talented draft prospects declaring for the U.S. banking league. But the scouts? They just keep sending them back to college to run it up for one more year. Regulators are playing extremely tight zone defense right now. Having a sleek user interface and good vibes simply isn't going to cut it if your paperwork and compliance aren't airtight. So that leaves us with a pretty fascinating question. If regulators are keeping the gates locked on these shiny new neobanks, where else is our digital money going? How are consumers actually choosing to spend and store their everyday cash? Section 3, the play. Venmo joins Google Play.
So as of Monday, Venmo is officially a payment option on Google Play. They're joining heavy hitters like PayPal and Cash App as a supported third-party option right alongside your traditional card networks. Now, millennials and Gen Z have already been using Venmo to split everything from dinner to rent. But just look at what Venmo can fund now on Android. Apps, games, yes, you can now seamlessly buy Clash Royale coins with your Venmo balance, plus in-app purchases and subscriptions. You can use your parked Venmo balance, a linked bank account, or connected cards to instantly fund all your digital and gaming habits.
And this brilliantly illustrates exactly why they're making this move. $167 billion. That is the sheer scale of the projected 2025 in-app spending market across iOS and Google Play. That market is up a staggering 10.6% year over year. Venmo's general manager basically framed this as a direct play for the demographic that treats a digital wallet way less like a traditional bank account and much more like a lifestyle choice. They want a big piece of that massive $167 billion pie.
Which brings us to the ultimate strategy for parent company PayPal. This move is kind of like creating the gym membership you literally can't cancel, but, in a good way for the business. Making purchases this frictionless is an absolute masterclass in ecosystem retention. Every single new rail Venmo gets added to just gives users one more reason to keep their balance parked right there in the app, rather than draining those funds back into an actual traditional bank account. PayPal doesn't just want to move your money. They want your money to live permanently inside their walls.
So the crucial point here is how these three completely different weeks paint a really unified picture of the digital money business. 1, infrastructure is quietly scaling up in the background, making sure systems don't crash and businesses can expand globally, just like we saw with Toast and Adyen. 2, regulators are standing firm at the gates, proving for sure that compliance still reigns supreme over cool tech, as Bunq unfortunately had to learn. And 3, consumer ecosystems are locking in. They're making it easier than ever to spend a parked balance before it ever even hits a traditional bank, courtesy of Venmo and Google Play. It's a rapidly shifting landscape where the very definition of banking is changing right before our eyes. Which leaves me with this final provocative thought for you to chew on today. As fintech silently eats the world and all these digital integrations become completely seamless, is your money actually in a bank anymore, or is it just permanently living in an app? Take a look at your own phone and really think about it. Anyway, thanks so much for joining me for this explainer. I hope this gave you some valuable clarity on the mechanics behind the money. Stay curious, and I'll catch you next time.